Today, we'll be diving into the Guyton-Klinger Guardrails withdrawal strategy, which is a dynamic spending approach for retirees. We'll cover what it is, how it works, and explore its different components in detail. Additionally, we'll look at 2 work-through examples and discuss its pros and cons, including some criticisms from industry experts. We will close with some options to address its drawbacks. The 2 examples are quite extensive, so feel free to skip ahead using the chapter markers below, if you prefer not to delve into the details. If you find topics like this helpful, take a moment to subscribe for future content. Your support is always appreciated. The Guyton-Klinger Guardrails strategy is a retirement withdrawal strategy designed to help retirees manage their money in a sustainable way throughout their retirement years. It's named after its creators, Jonathan Guyton and William Klinger, who developed it based on extensive research in the field of retirement planning. It's designed to help retirees navigate market volatility and sequence of returns risk, which is the risk of experiencing poor returns early in retirement, potentially depleting the portfolio prematurely. Guyton and Klinger's 2006 paper, featured in the Journal of Financial Planning, analyzed their strategy's effectiveness using Monte Carlo simulations, conducted over a 40-year retirement period, surpassing the conventional 30-year retirement horizon, often associated with the 4% rule. Personally, I find the Guyton-Klinger decision rules unnecessarily complicated. I am going to take a slightly unorthodox approach to simplify how we look at the decision rules. Now, this might raise some eyebrows, but bear with me. First, I am going to introduce alternative names for some rules that I believe are more intuitive, and categorize these rules into 2 logical sets, to streamline the discussion. Second, I am going to propose a simplification to the rules, for those who are seriously considering adopting this. I'll explain later what this is and why. While purists may object to this, I hope adding this lens, to simplify how the Guyton-Klinger decision rules are presented, will make them easier to understand and more practical to adopt. For those who want to understand the original decision rules, I have included a link to the original 2006 paper in the description below. Okay, onward. In their 2006 paper, Guyton and Klinger start by discussing Guyton's original 2004 paper, and the rules introduced in this earlier work, some of which are adopted in the Guyton-Klinger withdrawal strategy. I refer to the original Guyton decision rules as the foundational rules, well, because they simply are. These rules form the underlying foundation for the new guardrails, but are not guardrails in and of themselves. There are 3 rules in Guyton's 2004 paper. First, the inflation rule states that annual spending increases with inflation, capped at 6%. However, its application may be restricted by the withdrawal rule, which brings us to the second rule. The withdrawal rule determines how much you can withdraw from your retirement portfolio each year. It's based on a percentage of your initial portfolio value, adjusted annually for inflation, with one exception. If the portfolio's performance was negative in the prior year, then you forego the increase that year and spending remains unchanged. The 2 rules are a little circular in nature, and more convoluted than necessary in my opinion. Finally, the portfolio management rule helps to determine the source of funds for each year's spending from your portfolio. It follows a very specific order, to ensure your portfolio is optimized, by withdrawing from better performing asset classes, favoring overperforming equities before overperforming fixed income. The reverse order is used for underperforming asset classes. Just as an aside, I'd rename 2 rules. I'd call the inflation rule, the inflation cap rule, to reflect its primary purpose to cap increases above 6%. I've always found the portfolio management rule rather confusing, and I think of this as the withdrawal order rule, as it prioritizes which asset classes to tap into, based on their performance. In the 2006 Guardrails paper, Guyton and Klinger made 3 key changes to Guyton's earlier approach. First, they dropped the inflation rule. Second, they revised the withdrawal rule. And third, they introduced 2 new rules, that I refer to as guardrail rules. Well, because these essentially define the guardrails that Guyton-Klinger's strategy has become synonymous with. The revised withdrawal rule now adjusts spending to match inflation, except in cases where both the previous year's portfolio performance is negative, and additionally, the revised withdrawal rate exceeds the initial withdrawal rate. The latter is the refinement. The revised rule tightens the criteria for skipping inflation adjustments, which helps your withdrawals keep pace with inflation. Now, we come to the two new guardrail rules, at the heart of the Guyton-Klinger Guardrails strategy. The capital preservation rule aims to preserve the portfolio by reducing the estimated withdrawal rate for the current year by 10%, if the current year's withdrawal rate is projected to increase by more than 20% of the initial withdrawal rate. This rule protects the portfolio from depletion in the event of severe market downturns. You can think of the prosperity rule as the inverse of the capital preservation rule. It increases the estimated withdrawal rate by 10%, if the current year's withdrawal rate is projected to decrease by more than 20% of the initial withdrawal rate. This rule loosens the purse strings a little, and increases your withdrawals, to help you make the most of your retirement in better years. In both cases, the revised withdrawal amount becomes the basis for determining the next year's withdrawal. One important note on the capital preservation rule: it is not applicable 15 years before the end of the retirement period. So, no pay cuts towards the end of your retirement. The reason? Guyton-Klinger found that decreasing spending power in this period did not translate to any meaningful increase in the probability of success in their 40-year simulations. Intuitively, this makes sense, since market downturns towards the end of retirement have less impact on portfolio longevity compared to downturns at the beginning of retirement. That sequence of returns risk for you. This aligns with the retirement smile when spending is typically higher towards the end of retirement. Again, a quick aside on rule names. I personally think of the capital preservation rule as the upper guardrail rule, and the prosperity rule as the lower guardrail rule. The upper guardrail defines a ceiling which triggers a reduction in spending, while the lower guardrail defines a floor which triggers an increase in spending. I find these names more representative of their function, and generally more intuitive. Now we have covered all the decision rules, let's take a look at two worked-through examples to bring these rules to life. One with a later bear market, and the second with an earlier bear market. Before we look at the first example, let's quickly go through the structure of the spreadsheet. I have broken down each of the constituents to calculate the actual withdrawal amount, starting with inflation. Actual inflation versus the adjusted inflation after applying the withdrawal rule, which forgoes inflation adjustment after a down market. The withdrawal rates are here only for reference, and define the guardrail thresholds. This is followed by the projected withdrawal amount and rate. The projected withdrawal rate is a crucial input into the decision rules, to determine if any course correction to the withdrawals is needed for the given year. This brings us to the four parts that constitute the Guyton-Klinger section. The first two tells us if the upper or lower guardrail thresholds were breached. The outcome is summarized in the third column, and the fourth indicates what the withdrawal adjustment is, after taking the rules into consideration. If we're on target, the adjustment is 100%, essentially no adjustment. If the upper guardrail is breached, the adjustment is 90%, which is 10% cut to the projected withdrawal, and 110% if the lower is breached, giving you a 10% pay rise. The rest of the columns are quite self-explanatory. I have added a separate section to track real purchasing power. The first tracks the real portfolio growth, taking into account inflation. The next columns track the difference between the actual withdrawal against the inflation-adjusted withdrawal. Additionally, we have the accumulated delta to the inflation-adjusted withdrawals, up to the current year of retirement. This provides an indication of how far we're currently ahead or behind, in terms of keeping up with the cost of living. We will come back to this when discussing pros and cons. We have already seen parts of the first scenario. It's difficult to talk through the structure of the spreadsheet without some real data. Let's walk through the rest of it. As you can see, the first 3 years are quite unremarkable, insofar that times have been pretty good, with 10% growth in the first year, 20% in the second year, and 25% in the third year. Up to this point, we are on target, with spending falling within the two guardrails. But you can already see the projected withdrawal rate trending downwards, to the lower guardrail, at the beginning of year 3, with a withdrawal rate of 4.45%, due to the strong portfolio performance. For these years, the final withdrawal amounts are unadjusted from the projected withdrawal amounts. Let's pick up from year 4. Unsurprisingly, this year starts off really strong, with the real gains of 49% from the prior years. One would expect the Guyton-Klinger rules to say, "You've had a good run, go ahead and reward yourself," and that's exactly what happens. The lower guardrail rule kicks in, as the projected withdrawal rate for year 4 breaches the lower threshold, due to strong market gains. So instead of withdrawing £54,600, we get a pay rise of 10% and withdraw £60,100. I'm rounding off the numbers to keep things simple, but you can see the actual amounts on screen. Now, let's suppose we hit a bear market at this point, with the portfolio value declining 30%. As you'd expect, the projected withdrawal for year 5 will not be adjusted for inflation, due to the negative performance in the prior year. Due to the significant drop in the portfolio value, we immediately breach the upper guardrail threshold in year 5, resulting in a 10% pay cut, dropping from the projected withdrawal of £60,100 to £54,100. This puts us £2,200 below the real cost of living, had our withdrawals been adjusted for inflation every year. Here's where spending flexibility and any additional income is key. If you can cut your discretionary spending by £2,000, or if you can make up the difference with income from a side hustle or part-time work, then, technically, you're still fine. If you can't, then this starts to impact your standard of living. Looking further to year 7, what's interesting is, despite 5% growth in 2 consecutive years, the pace of recovery isn't enough to keep us below the upper guardrail threshold, and we're hit with another 10% pay cut in year 7. This reduces our withdrawals to £51,600, which is just barely more than the inflation-adjusted withdrawals for year 2, some 5 years earlier. Unsurprisingly, this puts us way behind in real purchasing power, some £8,000 below the target spending. No matter how you cut it, this is a substantial drop in spending. What the Guyton-Klinger decision rules are telling us is, the recovery isn't sufficiently robust to match spending levels, so we need to take yet another pay cut. This scenario isn't too far-fetched, especially when we consider some of the bear markets in recent history. Finally, let's just quickly look at the withdrawal rate view. Placing this side by side with the withdrawal chart gives you both viewpoints, and an insight into the conditions when the guardrails are applied, one in terms of withdrawal amounts, and another in terms of withdrawal rates. You can see the lower guardrail breach in year 4, which bumps up the withdrawal rates, and the upper guardrail breach in years 5 and 7. These demonstrate the Guyton-Klinger decision rules in action. Now, let's briefly look at the second scenario. The primary difference? The bear market hits earlier in retirement, resulting in a 30% portfolio loss in year 2. So let's see how Guyton-Klinger handles sequence of returns risk. No surprises, we immediately hit the upper guardrail threshold, and take a 10% pay cut. In real terms, this translates to a spending cut of £6,700 in real terms. That is, you would need to withdraw £53,000 to keep pace with inflation, but instead, we are withdrawing £46,300. This is a substantial pay cut. Suppose the market bounces back immediately, with a 50% growth that year. And again with 20% the next year, and 17.5% the following year. Notice that the massive, and slightly unrealistic 87.5% portfolio growth, in 3 subsequent years, is still insufficient to reward us with a pay rise. While withdrawals are gradually increasing in this period, from £47,700 in year 4 to £50,600 in year 6, notice that these increases have not kept pace with inflation. Look at the purchasing power columns. What we see is a widening gap to inflation-adjusted spending each year, rising from £6,700 in year 3 to £7,300 in year 6. That's a tough pill to swallow, especially for an extended 4-year period. The 10% growth in year 6 finally tips the balance in our favor for a pay rise, as the 4% lower guardrail threshold is finally breached. But it took 97.5% growth to reward us with our first pay rise, since the end of the bear market. Here is the withdrawal rate view of the same scenario. Again, placing the 2 viewpoints side by side, provides an insight into the conditions when the guardrails are triggered. You can see the upper guardrail breach in year 3, which reduces the withdrawal rate for that year, and the lower guardrail breach way later in year 7. This illustrates the length it took, after recovering from the bear market with unusually strong growth, for the pay rise to kick in. I hope this helped you understand the mechanics of the Guyton-Klinger decision rules in action, and also importantly, get a feel for how it behaves in different market conditions. This leads nicely to the pros and cons. The pros are quite obvious, so I'll keep these brief. First, the decision rules improve portfolio longevity, by enforcing spending cuts when the portfolio drops below certain thresholds. Second, They help balance spending flexibility with longevity risk, by allowing spending increases when the portfolio grows, while enforcing spending cuts when the portfolio shrinks. Third, the decision rules help mitigate sequence of returns risk, by reducing spending in response to poor returns early in retirement. Fourth, the decision rules allow for potentially higher initial withdrawal rates, compared to some static strategies like the 4% rule. This provides more spending flexibility both early in retirement and later in retirement, which aligns well with the retirement smile. Finally, the guardrail strategy outlines clear decision rules for adjusting withdrawals, providing retirees a reasonable starting framework for developing a spending strategy in retirement. Now, on to the cons, and we are going to spend a little more time here. First, the decision rules may be difficult for some retirees to follow and implement, as they involve calculations and decision points. Let's be honest, you'll need an Excel spreadsheet. To be fair, this is no different if you're looking at implementing, say, the Vanguard Dynamic Spending Rule or the Kitz's Ratcheting Rule. That said, the Guyton-Klinger decision rules are a little more involved than these rules, the ratcheting rule being the simplest, but the good news is, once you're set up, you should be fine. They will also require ongoing monitoring of your portfolio performance and adjustments to your spending plans. This will not suit retirees who prefer a simple set-it-and-forget-it approach. There's no free lunch. Flexibility comes at a cost. Second, one common criticism is that the guardrail rules are too conservative, which could impact your retirement lifestyle. Not only do they favor aggressive cuts in market downturns, and maintaining depressed spending rates over long periods, they are also not as responsive to restore spending when markets recover. We saw this behavior in the two examples we looked at. Was that an anomaly, or is this characteristic of the Guyton-Klinger rules? The article by Tharp and Justin Fitzpatrick, published on kitses.com, concurs with my informal findings. In fact, they observed and reported the same behavior using Monte Carlo simulations, and they summarized their findings in the article. They also summarized the findings from other financial experts such as Wade Pfau and Karsten Jeske, who manages the excellent Early Retirement Now blog. There is clear consensus. Guyton-Klinger decision rules are very conservative, resulting in significant cuts in withdrawals, and favor maintaining depressed withdrawal rates over long periods. Tharp and Fitzpatrick found that the Guyton-Klinger rules would have resulted in a reduction of 36% in spending during the dot-com crash, and 28% during the global financial crisis, relative to planned, inflation-adjusted spending. That's significant. The guardrail rules do help preserve portfolio longevity, no doubt about that, but at the expense of drastic spending cuts. Third, besides a lower standard of living during down markets, another consequence of the decision rules is potential for significant spending volatility. This can lead to increased stress and anxiety for retirees, especially those who prefer a more stable income, or those less prepared to adapt their spending. The flexibility in the guardrails comes at a cost, both financially and emotionally. Now, does this mean that you should avoid the Guyton-Klinger decision rules? No, far from it. On the contrary, a number of well-respected financial experts including Wade Pfau, Michael Kitzes and Matthew Jarvis generally acknowledge that the decision rules provide a good framework for developing a spending strategy in retirement. However, there are a number of things I'd do differently. First, I'd drop the unnecessary and convoluted portfolio management rule that defines the order of withdrawal by asset class and performance. Just rebalance. Simple. And I'm not alone in this. Karsten recommended the same in his blog on safe withdrawal rates in 2017. The interesting thing is, Guyton and Klinger didn't find this rule to be particularly effective either, in their simulations. The improvements over not implementing the portfolio management rule is, at best, marginal. Given the unnecessary complexity it entails, it's a no-brainer to drop it in favor of simple rebalancing. Second, consider playing around with the core parameters such as the guardrail thresholds and withdrawal adjustments, and running these through Monte Carlo simulations to understand the outcomes. This process may help you find the parameters, or possibly a range of parameters, that work for your personal circumstances, financial goals and risk tolerance. I agree that Guyton-Klinger provides a great framework to discuss and structure your retirement spending. But don't feel wedded to the original parameters. Instead, use these as a starting point to find something that works for you. I'd say this also applies to other dynamic withdrawal strategies, such as the Vanguard Dynamic Spending Rule. And finally, consider combining the decision rules with complementary strategies to address the tendencies for the Guyton-Klinger rules to be conservative. These strategies can be used either separately or together to navigate severe bear markets and alleviate extended reduced withdrawals. First, maintaining 2 to 3 years of living expenses in cash reserves serves as an essential buffer for market swings without having to sell depressed investments. Second, creating a discretionary spending tier by categorizing expenses as essential versus discretionary can provide more spending flexibility. Examples of discretionary spending include holidays, dining out, hobbies, and subscriptions. These can be reduced in down markets, but plan for this in advance, so you know exactly how much discretionary spending you can flex. Third, if you have additional income streams outside your investment portfolio, this will alleviate the pressure on your retirement savings. This could be a part-time job, a freelance contract, a side hustle, rental properties, or fixed-term annuities in early retirement. Finally, using the bucket strategy helps reduce the pressure to sell growth investments in a down market. I suggest exploring the simplified bucket strategy I discuss in another video. This is a straightforward 6-year, 2-bucket strategy, designed to offer peace of mind without the unnecessary complexity of the 3-bucket strategy. Its simplicity and effectiveness stem from adopting the total return approach and simply rebalance. Let's wrap up. The key benefit of the Guyton-Klinger decision rules is that it provides a structured framework that enables you to strike a balance between spending flexibility and portfolio longevity. By allowing for withdrawal increases in good years and enforcing decreases in poor years, it seeks to mitigate the impact of sequence of returns risk, while also providing a degree of spending flexibility. There are a number of cons, not least its tendency to drastically cut spending. However, you can alleviate these to some extent by combining the Guyton-Klinger rules with complementary strategies. If you are still here, thank you for your time, and I hope you found this helpful. Don't forget to like, share, and subscribe for more content. It will help our channel grow. Thanks for watching, and I'll see you in the next one.